Okay, so chapter 5, merchandising activities. How many of you were able to actually read the chapter? Nobody? So far for chapter, well, up until chapter 5, chapter 1 through 4, we had been learning about inventory through just a basic line item. So inventory and uh, net income, those types of things. With the merchandising, we're looking at it from several different areas, starting with uh, how it's different from the normal process when we're talking about service organization. Up until this point, you have um, learned about providing a service and then earning revenue, right? And then, of course, to get your net income, you subtract expenses from your revenue. But in a merchandising situation, this is typically how the process goes. The only ones that we are actually concerned with are the two in the middle. Which are the retailer and the wholesaler. So in this case, of course, we know the wholesaler purchases from the manufacturer. Good morning. And when the wholesaler purchases, what we are concerned about are purchases, um, returns, and allowances. And also purchases discounts. And then from the retailer standpoint, we're looking at sales, returns, and allowances. And sales discounts. So I'll let you write that down before I move forward. Okay. So let's look at the difference now between what you've known so far of how to get to net income. Um, Instead of it being a straight revenues minus expenses equals net income, now that we're talking about the merchandising business, it goes a little different. So instead of calling revenue revenue, we call it net sales. And we subtract out cost of goods sold, which you'll learn about that in a minute, which equals gross profit. And then from gross profit is when you minus your expenses so that you can still get to your net income. Down here at the bottom is kind of an example of how a partial income statement would go for a merchandising business. So how do we report inventory? So far, you haven't had to deal with inventory. In this particular chapter, you do. So the way that it works is that the merchandiser purchases the inventory, puts it into their merchandise inventory account. They sell it for either cash or put it on an accounts receivable or credit sales. And then, of course, they work on collecting their money for the merchandise. So this is very important because ultimately you're trying to get here to merchandise available for sale. So you start off with whatever the beginning inventory is and you add in any purchases for the period. And that's going to give you the merchandise that is actually available for sale. Now, once you sell it, of course, that's going to decrease ending inventory. And anytime that you have inventory left on hand, you must add it to cost of goods sold to get ultimately to the final cost of goods sold amount. So here are the two inventory systems that we're most concerned with. Perpetual just means they count inventory on a more frequent basis. They could count it by the month, the quarter, so quarterly, semi-quarterly, it just depends on the business. But they count inventory or they update inventory as they go along. Whereas a periodic system, this is probably annual and once a year. So it could be at the end of the year. And of course at the beginning of the year. So that's the only thing that you need to know about the two differences between inventory. Perpetual is more frequent. It could be by the month, it could be by the week, it could be by the quarter. It could just be as they go along, as they make sales. Whereas periodic is probably at the end of the accounting period or year, or at the beginning of the accounting period or year. So now we're just going to deal with the purchases for now. So on November 2nd, the company, they purchased $1,200 worth of merchandise inventory for cash. And they're purchasing that inventory so that they can do what? Sell it. And so they purchased it for $1,200 and we credit cash. Now, merchandise inventory, that account, I don't want that to throw you off. It's the same as inventory as you've been seeing up until this point. It's the same thing. It's just we're dealing with merchandisers, so we have to call it merchandise inventory. But debit merchandise inventory because it is increasing $1,200 and crediting cash for $1,200 to show the purchase. This is just an example of what a typical invoice may look like to show the purchase of product. Now, I told you about the discounts with purchases, and what you have always is if you have been given a discount, you have a discount period. The discount period will be in a number of days. So normally we know if you purchase something on account, typically you get about 30 to 60 days to pay the invoice off. Sometimes if you purchase something on account, you may have a good rapport with the supplier, so they may say, I'll extend to you a discount if you pay the full amount of the invoice within X amount of days. So this is where that comes in. You have 2, which means 2% discount. You have 10, which is the days, okay? N, which means net, and then 30, which is also in days. So what does that actually mean? What it means is that the supplier may extend to you and say, I will give you a 2% discount if you pay the full invoice amount within 10 days. And if you don't pay it within 10 days, you don't get the discount, and I'm expecting the full amount within 30 days. Does that make sense to everybody?
So the amount of the actual purchase would be the same, right? Or is that just the way that they write? Or is the amount actually goes?
Net means the net invoice amount. Yeah.
Morning.
So 2% discount if it's paid within how many days?
10 days.
10 days. And if not paid in 10 days, then the full invoice is due in 30 days. So here's an example. That's still that $1,200 that they purchased, but now they have terms of 210 in 30 or net 30. And so if they took advantage of the discount, remember the date of the purchase was November 2nd. It's now November 12th, so they're within those 10 days, right? So now they can get the discount. So the way that we get the discount, we take the full amount of the purchase, we multiply that by 2%, which equals $24 of a discount. So we debit our accounts payable to write it off of our accounts payable for the full $1,200. We credit merchandise inventory for the $24 discount. And we also credit cash for the cash that we actually had to pay out, which was $1,200 minus $24.
Okay, that indicated with what?
To calculate the discount, you take the full amount of the invoice and multiply it by the percent to get the amount of the discount. Accounts payable is decreased by $1,200 because they're paying this invoice off, right? They got a discount on it, so they're not paying the full $1,200, but we still have to write the full $1,200 off of the books out of accounts payable because it's satisfied. We credit merchandise inventory for that discount amount of $24, and we credit cash, which is what we actually had to pay out, which is $1,176.
Okay.
Do you guys have questions before I move forward?
I'm a little confused why we're crediting inventory for a discount. The value of the inventory is still the same, right?
The value of the inventory is still the same, but what we're basically saying is, okay, look at it like this. It would be no different if you went and purchased that inventory and they gave you a discount right then and there on it. It's not saying it's a decrease in the actual physical count of the inventory. It's just saying that it's valued less than $1,200. So that's why we decrease inventory. It's not taken away from the physical count. It's just saying that the value is less than $1,200 because I gave you a discount. So these are just the T accounts. You got merchandise inventory, which is an asset. And so we showed a increase in $1,200, a decrease in value of $24 for the discount. And now the balance is $1,176. Accounts payable was increased by $1,200 and then decreased once it was paid on the 12th for $1,200. Now purchase return. Sometimes you may have to return
inventory back to the supplier for whatever reason, and sometimes something may be defective or broken or something like that, and you may have to still return it. And instead of you getting money back, you would get um, an allowance or a credit. So here's how that works. Apparently, items were returned because they were defective. So the company honored a $300 debit memorandum or debit memo. So we debit or decrease our accounts payable by 300, and we decrease our merchandise inventory as well by 300 for defective merchandise. So to break that down, what is that saying? If I go and purchase more inventory from Trex, if my bill is $500, it's really going to be 200 because I have a $300 credit with them. Okay. And then merchandise inventory, a decrease of $300.
To account for the
So
return.
there's,
That's an allowance. That's an allowance. That's not a return. I mean, they returned it because it's defective, but it can't be put back on the shelf to be sold again because it's defective. So we call that an allowance.
so they're gonna give them the whole amount back.
No, just 300 of it, because only 300 was defective.
So the store would lose money to get there?
No, they gave, so the 300 gives them a cushion when they go to reward.
Right. Basically, you have a credit when you go to reorder. In this case, because we are the merchandiser, we don't really care how the loss affects the supplier. We don't care about that. But what we do care about is what do we have on the books the next time that we purchase with them. So the next time that we purchase, we'll have a $300 credit to use towards whatever we purchase. Have you ever returned anything to a
Right.
store and they've given you a gift card or some kind of store credit? That's the same thing. It's basically store credit. To
So the
be
store
used.
doesn't lose out, it's just the supply.
You as the merchandiser, no, you don't lose out. I don't care what the supplier does, but the merchandiser, you, the person that's purchasing the items, no, you don't lose. You have a store credit of 300.
The inventory has to decrease 20%.
Okay, so the store would lose out.
What store?
Okay, let's say I went to Walmart, for instance, and I purchased a TV. Or, let's just say something like a appliance, like a microwave. And I paid about, let's say, $150 for it. And so it's defective, it's not working, and so I take it back, they give me back my cash, it's $150. So who would lose out?
But this is not looking at it from a cash perspective.
Okay.
If you pay cash, you're gonna get your cash back.
Okay, so,
This is the same
Credit.
situation, but this is on credit.
okay,
So if your item is defective and you take it back, your inventory is gonna decrease because you're no longer gonna have the item, right?
right,
But the store also has to make sure that they refund you for the fact that the item was defective.
correct.
So they give you a store credit to be used whenever you come back, right?
Okay,
So that's the same thing they're doing here. Instead of saying it's a store credit, correct accounting terms are debit memo. But the next time that you purchase some items from me, you're gonna have a $300 store credit
okay,
to use
okay.
again. So here's where it's a couple of scenarios going on here. They purchased 1,000 of merchandise. The terms were $210 net $60. 2 days later, they returned $100 worth of goods. And then on June 11th, they actually paid out the bill. So let's start with June 1st. They purchased it, right? So you have a debit to merchandise inventory for 1,000 because it increases. You have a credit to accounts payable for 1,000 because it has increased. Now, 2 days later on June 3rd, they returned how much worth of goods?
$100.
$100. And so we are going to debit or decrease our accounts payable by $100, and we're also going to decrease our inventory by $100 because we're giving those items back, right? On June 11th, now they're ready to pay their bill, but when they pay their bill, they do not pay their bill based upon the $1,000. How do they pay their bill?
Based on the 900 and using the discount.
Based on the 900 that was left because we returned 100. So we take the 900 $900 bill and we multiply that by the 2% discount because we're paying it on June 11th, which is 10 days within that period, which gives us the $18 discount. So we debit our accounts payable or decrease it by the full $900. We decrease our inventory and value by $18. We decrease our cash by $882, which is the $900 owed minus the $18 discount. Any questions about that? No. Okay, freight. Who's responsible for freight? So in this case, you being the merchandiser and purchasing inventory so that you can sell it, FOB shipping point means that the carrier, or basically the person that is delivering this merchandise, the supplier, is responsible for the inventory up until what? It ships. So once it ships, it becomes the responsibility of the buyer, right? Versus, once it ships, it's the responsibility of the buyer. FOB destination, once it ships, it's the responsibility of who?
The seller until the buyer.
The seller until it actually receives. So the best way to break this down, typically when you order an item off of, let's just say, Amazon, you pay for shipping right then, right? And so you are determining that you are doing an FOB shipping point because you've incurred those costs up front, right? Versus if you order something off of the TV and it's COD or cash on delivery, that's FOB destination because that means that you don't pay for shipping until what? Until it gets to you, until it arrives. So these are the two journal entries that occur. If it's FOB shipping point, we debit merchandise inventory, obviously, because we are receiving inventory, and we credit cash to be paid. That's the buyer's standpoint. Seller for FOB destination, they account for it as a delivery expense, and then of course they collect the cash for it. Okay, so here's an example. Z-Mart purchased merchandise on terms of FOB shipping point. Transportation cost is $75. So we're going to debit merchandise inventory and credit cash for $75 paid up front for that merchandise. Now this is, or showing you rather, costs that come from purchases. You got the purchases you made, any discounts received are deducted, any allowances given are deducted, and any costs for freight are added in order for you to get the net cost of purchases, net merchandise purchases. And you'll see this breakdown on an income statement as well. So let's try to do this together. October 1st, they purchased 125 units of product at a cost of $4 per unit. Terms of the sale, 2% in 10 days or net 30. An FOB shipping point. The invoice is dated October 1st. So 10/1, to show the purchase of this product, what do I debit and what do I credit?
So it's 125 divided by 9 for, is it so that's 500.
$500.
Hold on, okay, $30 cash for freight.
Well, that part is irrelevant right now.
Okay, well, the cost of
Just
the
to
product
record
is
the sale.
500.
Okay, so 125 units times $4, right?
Uh-huh,
Equals 500.
uh-huh.
So what do we debit and what do we credit?
We're debiting
Flesh.
merchandise inventory.
Debit merchandise inventory. And what do we credit?
Credit cash for 30,
Is it cash?
because the freight charges are paid up front.
No, but they hadn't told you what they were on October 1st. You didn't know what the price was for freight.
You said pay $30 cash for freight charge.
On October 1st, you didn't know what you were paying for freight.
Oh, okay, accounts payable.
So accounts payable for $500.
Uh-huh.
Now, October 3rd, they paid $30 cash for freight charges from UPS for the October 1st purchase. So what do we debit?
Merchandise inventory. Is that ever listed, is freight charges ever listed as a separate line item or a separate,
From the buyer's standpoint, yes.
so would that $30 go in merchandise inventory or would it go in a shipping cost?
No, it goes under merchandise inventory.
Oh.
We'll talk about later when it's recognized as a delivery expense.
You mean $30?
Where'd you get 75 from?
I'm sorry. What is the credit account?
Cash.
October 7th, returned 50 defective units from the October 1st purchase and received a full credit. So you have how many units defective? And what do you multiply by? $4, which equals what?
200. Merchandise inventory.
Accounts payable.
No.
Accounts payable is debited. Because of 200. And merchandise inventory is credited for the 200.
Positive.
Uh-huh.
October 11th, paid the amount due from the October 1st purchase, less the return on October 7th. So
Is it gonna be the difference?
Did they pay within the discount period?
Yes, the 10th day.
They paid on the 10th day, so we must calculate that, but we cannot do that until we account for what?
You got the return.
The return.
So merchandise inventory. No, accounts payable.
So you had a $500 sale,
Uh-huh.
you had a $200 return, right? Which equals 300,
So that's what's accounts payable.
and multiply that
2%.
2%, which equals $6. So what do we debit and what do we credit here?
Accounts payable
Mm-hmm,
is debited to 300.
okay.
How do we write
Then
this
you add
down?
the merchandise, the $6.
For the discount, right?
Mm-hmm.
Of $6. And then what's the last account?
Cash. For 294.
How much?
294.
So let's see if we were right. That looks correct. That's correct. Correct. And correct. And this will be saved and put in the class, in the blackboard, so you'll be able to go back to. Okay. Now, they've thrown something else in there. It says October 31st, assume the October 11th payment was never made, and instead a payment of the amount due on the October 1st purchase less the return on October 7th occurred on October 31st. So if they didn't pay it until October 31st, that means that they did not get what?
The discount.
The discount.
So it's 300.
So it's just gonna be 300 and debit to what?
Accounts payable. For 300.
And credit to,
Cash.
okay. So let's switch it over and look at sales. Now, we purchased the product, right? And now we're ready to
So
sell it to consumers. So this is the difference. It's really not much. Sales, subtract out all discounts and subtract out all allowances to get net sales. Then you subtract out cost of goods sold. Now, cost of goods sold is considered to be an expense. Now, you should not write cost of goods sold expense. Just know that it's an expense, and it goes on what statement? Income statement. So you subtract cost of goods sold from net sales in order to get gross profit. So sales of merchandise. Revenue For merchandisers, we call it sales. It's all the same. You basically give a customer product, and if you don't get cash, of course, you put it where? Accounts receivable, right? Something that you need to write down and remember is that anytime you sell an item, you also have to account for the cost of that item. So anytime you sell an item, you must account for the cost of the item. And it's always, anytime you sell an item, it's always going to be 2 journal entries under merchandising. So anytime you sell merchandise, you must account for the cost of the merchandise. Again, when you sell merchandise, you must account for the cost of that merchandise. So in plain terms, all that means is this. If I sell Ebony $500 worth of product, when I put down my journal entry for the sale of that $500 worth of inventory, I'm also going to do a separate journal entry to account for the fact that it cost me $250. Does that make sense? So I account for the sale of the 500 units, and then I turn around and do a journal entry for what it cost me. I have to account for what it costs me.
But I thought that the cost of the goods was already accounted for in the merchandise inventory.
It is accounted for in merchandise inventory, but you also have to account for what it costs you to take it out of inventory once you sell it. This is the journal entry I'm referring to. So this company, our company, sold $2,400 worth of merchandise on credit, right? So we created an account's what? Receivable. The merchandise has a cost basis of $1,600. So our first journal entry is to account for the actual sale itself of merchandise. So we debit accounts receivable or increase accounts receivable $2,400, and we credit our sales. It will be no different if you debited accounts receivable and credited revenue, services revenue, same thing, right? Accounting for the cost of it means you're taking it out of your inventory because it's being sold. So we debit cost of goods sold, and we credit merchandise inventory to decrease both of them.
Oh, so that's what
And notice the description: sold merchandise on credit to record the cost of that sale. And that keeps us in line with the matching principle, meaning we match expenses with revenues in the same period in which they occurred. So with sales, it's the same thing. You might extend discount terms to a customer within a certain discount period, or a certain number of days. So here are 3 different assumptions. First one is they sold $1,000 worth of items. So we debit accounts receivable, we credit sales for that $1,000. Now it says the account was paid in full within the 60-day period. So this is assuming no discount, right? They didn't meet the discount date. So we just credit our cash and decrease our accounts receivable by that amount. And then this third scenario is the account was paid in full within the 10-day discount period. So we have to give them that discount, right? So we do the $1,000 times what? 2%. Which gives us $20 of a discount. So we debit our cash for $9.80 because we received cash. We debit our sales discounts for $20. And we credit our accounts receivable for the full $1,000. So under sales, we still have sales returns and allowances if you're selling a product or selling inventory. You still may have items that are returned by a customer. You still may have to extend allowances to a customer based upon something being defective or broken or the wrong color, whatever the reason may be. And so here's an example. They sold at $2,400 worth of product. We know it cost them $1,600, right? But the customer returns part of the merchandise, and the portion that they returned back was worth $800, but it cost you $600. Now I don't want anybody to get confused. So starting with what was returned, $800 was returned, right? So we debit sales returns and allowances for that $800, and we credit our accounts receivable or decrease our accounts receivable. And then it cost us $600, right? You remember how I said every time you account for sales, you have to also account for what? The cost of that sale. So in this case, since they're returning what you sold them, you're going to put it back in your inventory for $600 because they're returning the items to you, right? And then you're going to increase again your cost of goods. So,
I got a question. This is assuming that this is not.
They didn't say it was defective. They just said returned it. If it's defective, they're going to say it was defective, which means you give an allowance, not return it.
Okay.
But this is not defective. This is just returned merchandise. So we have to put it back in our inventory to be resold later on. And then also put the cost back into our cost of goods sold. Yes, ma'am.
On the journal entry, he actually lost $200 between the return
He didn't lose $200. He charged the client $2,400, and they returned back $800 of it.
Okay.
Just like it cost him $1,600 before for all of the $2,400 worth of inventory. He's just putting back in his inventory what it cost him, not the value of the $800 he sold it for.
Okay.
Does that make sense to everybody? Does anybody else have questions about this particular journal entry? Okay, now this is talking about defective items. It says assume that $800 of that merchandise sold on November 3rd is defective, but the buyer decides to keep it because Z-Mart offers a $100 price reduction.
What?
So in this situation, the items are defective. And what is happening is the customer, instead of just returning the items, they just keep them. And the customer just gives them $100 off. And typically that will happen because the merchandiser doesn't want the items back because they can't sell them, they're defective. So it's like, just for you to keep them, I'll give you $100 allowance. All right, so debit to sales returns and allowances for $100, and then a decrease or credit to account receivable for that customer. So let's do these journal entries. June 1st, sold 500 units of merchandise to a customer for $14 per unit under credit terms of 2/10 net 30 FOB shipping point, and the invoice is dated June 1st. The merchandise had a cost of $10 per unit. So June 1st, the sale of the merchandise, how many units did you sell? 500 at what price? $14, so that's $7,000. What do we debit over here to show this sale?
Merchandise inventory.
You sure?
Accounts receivable.
It's a
Oh,
sale.
no, oh, we sold the
sales.
accounts receivable.
Accounts receivable. And then credit what?
Sales.
For 7,000, right? And then because you sold something, you now have to account for what?
Cost of goods
Cost of
sold.
goods.
Cost of the goods that you sold. So we had 500 units times $10, right? Equals 5,000 is what it cost us. So we're gonna debit what and credit what?
Cost of goods sold.
Debit cost of goods sold.
And, credit merchandise inventory.
For the 5,000, right? All right. June 7th, the customer returns 20 units because those units did not fit the customer's needs. The seller restores those units to its inventory. So
So you have
they returned 20 units, and how much did they pay for them?
280.
$14, right?
Yeah.
So that equals 280. What are we gonna debit and what are we gonna credit?
Accounts,
Remember, the inventory is coming back to us,
yeah, sales returns and allowance
okay?
for the 280.
We sure?
And accounts receivable for the 280. We're gonna debit sales and allowance. I mean, returns and allowance.
No, you had sales,
Yeah, and allowance.
for
280.
280. Credit what?
Accounts receivable. 280. And,
Why?
cause cost of goods, we have to take out of cost of goods, right? So merchandise inventory. Cash. Oh, okay. Okay. So
Where you account for a sale, you must account for the cost of that sale. Where you account for a return, you also must account for the cost of that return.
Okay.
So we put the 200, and where we got 200 is 20 units times the $10 we paid for it, right? So we put the inventory back in our stock for $200, and we also increase our cost of goods sold. Everybody clear so far? Now here are some more transactions. June 8th, the customer discovers that 30 units are damaged, but are still of some use, and therefore they keep the units because the seller sends the buyer a credit memo for $90 to compensate for the damage. So 30 units are damaged, but they were not returned. The customer just decided to keep them. So the client extended a credit memo to them. So what do we debit and what do we credit?
Sales is debited.
Sales?
Okay, I'm confused with it.
The customer,
She's not sending it back, so we're not messing with merchandise inventory.
right,
We're not messing with cost of goods sold.
correct.
So we're just messing with
We're just giving them a credit
accounts
memo.
receivable.
So it's like,
And does that credit go in the sales return and allowance then?
What is it considered to be?
It's not.
It's not a return, but it is a what? Allowance. It's an allowance, right?
Oh, okay.
June 11th, the customer discovers that 10 of the units are the wrong color, but they keep 8 of them because the seller sends
Do it to it.
a $12 credit memo to compensate. The customer returns the remaining 2 units to the seller, and the seller restores those 2 units back to its inventory. So, all in one journal entry. They gave him a $12 credit, right? And then they returned 2 units, right? Plus 2 units times what price?
14.
Returning 2 units. What did it cost us?
The cost of goods would be $20.
Right. So 12 plus that $20, right?
So $32 goes in sales return allowance. But then we have to do a merchandise inventory and cost of goods sold, right?
So, no, because they didn't want you to record 2 different entries. They wanted to park it all up under one.
I'm confused.
So don't be. Whatever you understood up until this point is correct. All they were doing is basically saying they returned 2 items, and they also gave them a $12 credit.
Well, wouldn't the $12 credit deduct from the 28?
28.
The 2 times 14.
Mm-mm. Mm-mm. The thing
So
is,
then, in that case, we still have another entry to do then,
you
right?
don't. Mm-mm.
No, well, how do we?
They didn't want you to record the credit memo. They were just telling you what it was. They didn't want you to record it. What they're concerned about you recording are the 2 units that were also returned back. So 2 times 14, the 28, right?
Plus the $12.
Plus the $12 equals the full amount going into sales, returns, and allowances of $40, and accounts receivable being decreased by 40, and then what? The $20 is separate. So they really just wanted you to do things like you normally do. They just didn't want you to have to record the credit memo separate because it's all going into sales and sales returns and allowances. So it's still the same process. It's just a lot of extra work.
Because they doing too much.
So adjusting entries, typically the only adjusting entry that you would ever have to do in a merchandising situation is to adjust for like shrinkage and spoilage and those types of things. So it's really no different from what you have been doing with adjusting entries. They tell you how much inventory is left at the end of the year, and then they tell you what they start with. It's your responsibility to just subtract one from the other to get the amount to adjust, okay? And also you have to do closing entries just like you would with any other books. The only thing that has changed, remember I said cost of goods sold is an expense now, sales, returns, and allowances expense, discounts expense, so they just go where the expenses are for the closing entry. Sales, this used to be revenue, is still all the same, right? Closing revenue to income summary, then closing all expenses to income summary, and the rest stays the same. So let's look at this example. Okay, so with this, we are preparing the adjusting entry for shrinkage. Now, how much did they tell you was still left in inventory by the end of the year?
$718.
$718. And what was the beginning inventory?
756.
756. So that means that the shrinkage is what?
That first 70-something minus the 7%.
Which is how much?
$38.
$38. And all right, so this is showing the merchandise inventory. And what else do we need to also take into account?
For what?
Because if we had shrinkage for inventory, where else do we put it?
Cost of goods sold.
Good. So that $38 is debited to cost of goods sold for $38, and then credited to merchandise inventory for $38, which changes those final amounts. So now we can do the closing entries, and let's see what you remember from chapter 4. What's the first thing you do in closing?
Income summary,
Close what to what?
plus revenue to income summary.
Close revenue to income summary. How much revenue did you have?
3204.
3,000.
So what do we debit? What do we credit?
You debit, revenue.
Debit sales, credit
Credit
Income summary.
What's the next journal entry?
You debit income.
What are you closing to what?
Expenses.
Expenses to
Income summary.
income summary. So you debit income
Credit the
summary.
expenses.
And the expenses that we have,
Are sales,
discounts,
discount,
cost of goods sold, depreciation, salary, other operating, right? So we had sales discounts at $94. Just add all this up.
2,207. 615. 100.
Which means income summary is what? How much? You sure?
3318. 3,300.
Yeah, 3,318.
And then of course, you know, you do the other two journal entries, which is not required.
Can you go back to one more thing?
So the shrinkage entry went into cost of goods sold, right?
And your merchandise inventory. So this is just showing you the difference in the income statement, which is not really much of a difference. You just automatically deduct discounts and allowances from sales to get net sales, and then subtract out cost of goods sold to get gross profit. This is just a single step income statement, which is what you've been doing up until this point. And then you have a classified balance sheet where merchandise inventory would be housed because it is an asset. Okay. Now what I would like you to do